Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Lindsay. It's fantastic to have you back on the podcast show.
Well, it's great to be back. Yeah, I always enjoy talking with you about inflation. It's a good time to be talking about it again.
Absolutely. And so perhaps to kind of frame our conversation, maybe we could get your thoughts on how you think the inflation picture has unfolded so far this year. Obviously, people came into this year with one perspective, and instead the data has unfolded in a separate way. But how would you characterize what we've learned so far this year?
So to me, what's really shifted around inflation is much more the sentiment around it, much more so than the data. Whereas like when I look at core inflation has been trending about 4%, the month over month data, 3-month annualized, 6-month annualized, 12-month annualized. It's been trending around 4% for quite some time. I think what's really happened more is people have kind of given up on the idea that it's going to be declining much more from here. I don't think it's been declining for quite some time.
I
But
mean, what about the decline towards the end of last year? I mean, because people, including Powell, seem to say
yeah,
that this was the big turn in inflation in Q4 last year. I think that's partly what threw people off with this year's higher inflation
yeah, I,
numbers.
I think some of that was there was a decline in PC that the Fed looks at more that wasn't really showing up in the same way in CPI. Um, and then I think also just looking at some of the underlying trends, I think, getting really big picture, what what's been happening with CPI, I would say for the last 3 decades, is that goods inflation has been about zero, and services inflation has really been driving all of the inflation. After the pandemic, we had a big increase in goods inflation that was kind of anomalous, but that's gone back to zero. But services inflation, again, in CPI, not so much in PC, it's been trending around 5%. So you've been getting to 4% with an average of 5% and zero. And wages have been trending about 5%. So to me, it's all been very internally consistent that this is kind of where inflation has been going. I think when the Fed talks about looking at supercore, they're kind of talking about wages, but they can't really politically say that they're talking about wages. But wage growth has been coming down a bit, but it's still rather high, and it makes sense to me that services inflation is over the medium to long term kind of tied to wage inflation, and the job market tends to be, continues to be, very tight and pretty stable. So, this broader trend of relatively stable inflation, I think is consistent across economic data.
And you mentioned PCE, and obviously we know the Fed likes to look at PCE. Sometimes I wonder, is it because PCE is lower in general than CPI? But what are your thoughts on, the comparison between the two? I mean, why look at
Yeah.
PCE rather than CPI or vice versa?
So why the Fed looks at PC sort of goes back into history. I'm going to get the dates wrong, but I want to say back in, say, the 2000s, there was a lot of criticism of CPI in the basket. And the way CPI works is it's a fixed basket of goods that they survey every month. And what was happening in the early 2000s is you were getting a really rapid technological change in goods prices. So there was a lot of criticism of um, some of the models that CPI uses to adjust those. So, for example, if you have, a lot of this was happening in computers, for example. So, if the computer in the basket had, I don't know what would have been typical at the time, 1 gigabyte hard drive and, however much RAM. And then, the technology improves so much that a year later, that computer doesn't even exist. And the only computer has 2 gigabytes of, hard drive. So, how do you adjust for that? Where, there's been an actual improvement. I think people understand it from, in shrinkflation standpoint, where if you're paying $1 for a yogurt and it was 8 ounces and now it's 6 ounces and, it's still $1, that was actually a 25% increase. But when you have this sort of situation where the, the good is improving, but the price is staying the same, that's counting as deflation, but, how much deflation? So the PCE, because it's part of the GDP basket, it just adjusts more regularly, and sort of has a better, I think the Fed liked its adjustment for technological improvements better than CPI. I thought it was capturing that better. It's not quite as relevant now, but that's sort of when that change happened and why. It does tend to be lower. It has a bit of a lower weighting to the housing component, which I think is relevant right now. But the big picture, they're kind of measuring the same things, and I tend to move in the same general direction.
And for you, your first port of call would be CPI rather than PCE.
Yes, and that's because I tend to, invest in inflation products and, tend to, focus on the inflation metric that is used in the those inflation products because that's what you're actually paid in those products.
Yeah, understood. And so, from the sounds of things, it sounds like you're in the sticky inflation camp going forward as well. So when you look to the rest of this year, you mentioned services inflation is annualizing roughly, say, 5%. So that will kind of keep inflation at fairly elevated levels. I mean, is that your base case for the rest of this year?
It is. I don't really if I'm entirely honest, I haven't really understood the people calling for recession for the last, I don't know how 2 years. To me, the economy looks quite strong. I think I think we are in a higher inflation regime, and I think it is easy to kind of I think there's some metrics that work differently now than have worked, in the past. So, like, I guess one of the examples would be looking at some of the survey data. So, like, I like to look at the small business survey data, and it came in weaker recently. But if you look at why business owners are unhappy, they're unhappy because they're having a hard time finding labor. So, I think there's sort of a knee jerk to think that that negativity will feed into um, that negativity will feed into lower growth, where really what's happening is that negativity is reflecting, inflationary dynamics. And, I think that what ends up happening in an inflationary world is when people are feeling bad because inflation is too high and the economy backs off, then it tends to reaccelerate because, then you sort of get the opportunity to hire that labor that you didn't have before. Whereas in a disinflationary world, if people aren't happy because of growth and they back off, then you have the self-feeding cycle. So to me, we're sort of in a self-reinforcing cycle instead of a self-feeding cycle. And I think that's just something that people have missed about the inflation trend and also the growth trend in general.
Yeah, I guess on the recession side, I mean, people have looked at the yield curve, which had been heavily inverted. That didn't give the right signal. The PMIs, ISM, and such have been on the weaker side. And more generally, anything I suppose to do with the good side of the economy seems to be giving like very sort of recessionary type signals. Um, I mean, what do you say to all of those metrics?
Well, the yield curve, I just, I, I feel like we've had we've had central banks spending trillions of dollars, literally trillions of dollars to distort the shape of the yield curve. Yet we think that the yield curve shape today means the same as it did, you know, 30 years ago when we didn't have a central bank distorting the shape of the yield curve. I just don't, I don't really understand why. To me, that was at best a correlation relationship, not necessarily a causal relationship. So I didn't really understand that argument, to be honest. I think, on the manufacturing side, again, a lot of the negativity was from survey data. And I'm just not sure the surveys were saying what people thought they were saying. Yeah, but also on the manufacturing side, I think um, there's an element here where I think people miss the strength of some of the fiscal investment. When I look at things like manufacturing construction, that was very, very strong, and continues to be very, very strong, whereas sentiment surveys were negative. I just think that the hard data should have been given more weight than the survey data.
Yeah. And then on the recession side, um, I suppose a general point around that is the Fed has hiked a lot, at least in nominal terms. We're at 5.5%. I should also add, just timestamp this podcast. We're doing this before the Fed meeting, and also before payrolls. But nevertheless, I mean, the Fed has hiked aggressively. So many people said, okay, if you hike aggressively, the economy should slow, you should have a recession, and so on. So, what do you think about the relationship then between the hiking cycle and the economy then?
So I guess I think two things. One is um, it's the first part of that is it's real rates that matter, not nominal rates. And they were starting at a point where inflation was already very high. So I think what is hard about real rates is that when the Fed is unchanged and inflation is increasing very rapidly as it was, I think if you look at nominal rates, you think that the Fed is just doing nothing, where what's really happening is they're implicitly easing. Um, and I think there's an element of that that sort of wasn't misunderstood in terms of how far behind the curve they were. I think what was, sort of interesting in terms of the call for cuts is that as inflation has come down, the Fed was implicitly tightening. But then the real question is what is easy and what is tight? Sort of what is, R star, which is kind of, you know, honestly, it's something whenever I talk about it, I feel I can see people's eyes glaze over. It's just sort of a, boring conversation. But it's also really important because I think, um, when people talk about tight, there's sort of a recency bias. A lot of times when people say, rates are high, they're saying they're high relative to recent history, but, are they high for the economy or not? And to me, I'm more of an empiricist than the Fed can be. But, when I look at what's happening with commodities, when I look at what's happening with growth, I think that our SAR is probably a lot higher than the Fed is thinking. If you sort of plug in a Taylor rule model, we're still sort of operating in a world where we are assuming that the trend growth is 0 in there. And if you look historically, that's really, really low. If you go back to sort of a pre-financial crisis, we could be looking at R-star that's a lot higher. So, I think there's a case to be made that rates are still not restrictive, even though they are high relative to recent history. I'm not sure if that's the right argument, but I think that we're not sort of thinking enough about what the impact on rates is on the actual real economy.
Yeah, I guess one way of looking at that is if you look at, say, 5-year real interest rates in the US before COVID and after the GFC, that was extremely low, so 0.5 or I know something very, very low. But before the GFC period, it was often, I think, around 2% in real terms, 5-year, which for me is the market implied R star, you could say, just in terms of the way I think about it. And
Mm.
currently it's around that level. It's around 2%, I think, the 5-year real is roughly around that point. So what the market is kind of saying is that we're out of the post GFC regime of secular stagnation, low rates, and all of that. We're back in the pre GFC period,
That's right.
where back then the Fed would have been talking about R star at 2%, I suppose, not zero point 0.5. And the question then is the 2000s the right period? I mean, or 1990s or 1980s, which could push the R star even higher. Yeah, I mean that just to echo your point, that's one way I like to look at it.
Yeah, no, I completely agree. I think that we're still trying to figure out what that is, but I do think we're in a world where, getting to, a neutral Fed funds of, 0 real, I think is probably too low for the trend growth rate in the current economy.
Yeah, and on the Fed itself, how do you think the Fed has done over the last, say, 6 months? Because it does feel like the December Powell meeting where he turned quite dovish. That was a bit of a shock, I have to say, given where the data was. But how would you score the Fed so far, at least over the last 6 months?
Um, I think I would say overall they've done a really, really good job in a very challenging job that I think, a lot of people like me, can voice criticism. I wouldn't want that job. I would say overall, I think they've done a very good job. I think, um, I do think what concerns me about not just the Fed, but I would say a lot of sort of, you know, general neoclassical economic thought is, to be fair, it has been pretty wrong on inflation and has been pretty wrong on recession expectations. And I just think that's something that it's worth spending some time thinking about what in the models is wrong. And does that need to be adjusted? I think in terms of overall Fed policy, I think they've been pretty much getting to the the correct balance of risks. I think, you know, maybe they're faulty, maybe they're somewhat at fault in terms of forecasting what they thought they would do 6 months forward. But, it's been
Yeah.
a time where things have been changing a lot. I'm not sure that I've been that correct about, how it would feel 6 months
No,
from
that's
now,
fair. That's fair. I
2020.
mean, in the spectator stands, it's much easier to like comment on these things rather than when you're sort of involved in the game directly. Question on the models. I mean, what are some of the things you think they've got wrong in the models, especially the neoclassical approach? What do you think they've really missed?
I do think that sort of looking at the yield curve the way that it's been looked at, I think has been a bit. I would say it's outdated because I think the other part of it is just thinking about how modern loan creation happens, and how and banks' role in that versus credit markets and things like that. I just don't think that an inverted yield curve is contractionary to loan growth in the way that it may have been in the 80s. I think it's worth having some thought about how that's used. I think as I said, I think some of the survey data, and how it operated in the past and how it's operating now, is just very different. I think that's been a big reason for some false signals and I think misinterpretations of what people were actually saying. Um, and I think there's sort of a misunderstanding of some of the fiscal data and some of the multipliers. I think that what's happened with some of the CHIPS program, the Inflation Reduction Act. I think there have been some investments there that have had a multiplier a good bit greater than one, and I think a lot of fiscal multipliers are assumed to be, at best one. Um, and I think we've sort of forgotten that there are investments that can be made that can have much longer lasting impacts.
Yeah, and on the bond yield side, one of the interesting phenomena over the past couple of years, I would say, is when I look at, say, the 10-year US interest rate, a large factor that's caused the increase has just simply been Fed expectations. Obviously, the Fed's done a hiking cycle, the market's priced more hikes. There's been some kind of term premia. Well, we had a bit of a term premia shock last year, around the QRA and issuance and all those sorts of things.
Mhm.
Are you surprised that we haven't got more term premia in the curve now? The Fed has hiked rates. There is QT. Debt levels are very high. So, are you surprised we don't have more term premia in the curve?
I am somewhat surprised, but I think there are sort of two factors happening. I do think when I look at things like term premium and the yield curve, I do think, I guess how I would put it is, I think duration risk is still very, very mispriced. I think that when I look at the yield curve and I look at term premium, I think people are still paying for duration risk when I believe that you should be the one getting paid for duration risk. I think that's sort of a legacy view about the correlation of bonds and equities and whether duration is a good hedge for your equities that I think needs to be updated. But I think the other side of that is that income and yield from an investment standpoint, was really absent for many, many years. And I think the fact that it's back is really very, enticing. I think there's a lot of appeal to, being able to add income back into an investment portfolio. So from that side of it, I do sort of understand. I think the part that's sort of more baffling to me is, some of the people buying really long duration assets at these current valuations. I don't fully understand that. I think there's probably perhaps, a misunderstanding of how good a hedge that is for equities going forward.
Yeah. And then the other sort of element of all of this are inflation expectations, where at least longer dated inflation expectations have been remarkably well behaved, in the
Mhm.
last since COVID, in fact, overall. You would have thought that given surging inflation and the fact that the inflation target has been missed persistently, that inflation would be unanchored. What are your thoughts on that?
I think that I think the hard thing for a lot of those assets is sort of accessing them in a way that doesn't have duration risk. I think one of the things that's been really challenging for um, retail investors is just, if you look at some of the returns and some of those tips funds, even when inflation was going up dramatically, a lot of them were still, negative because it was being overwhelmed by the duration risk in those funds. I think it's just hard for a lot of people to access long-term, inflation expectations um, without sort of that duration exposure to it.
I mean, do you think there is a scenario where we could see unanchored inflation? Well, unanchored, what I mean is, let's say 5 years around two, 2.5. We go up towards 3 or 3.5. Say in the next year or two.
Um, you know, yes, I think that's possible. I think the way that it would happen, I think the Fed would actively fight against it. I think the only way, and I think that's sort of another perhaps problem for the product is um, that's something that the Fed very openly would not want to happen. There's a lot of research about how inflation expectations lead to higher inflation. So I think that's sort of a secondary problem with the product. And I guess to answer your question more directly, to me, the way that that would happen would be that the Fed was perceived to be in a situation where they couldn't tighten rates as aggressively as they might want to for yeah, a variety of external reasons.
Okay, great. And I mean, do you have right now in terms of bonds? Is your general view that bond yields, let's say the 10 year will move up towards say 5%, or we could even go towards 5.5? Is that the sort of the general sort of direction where we're heading towards?
Yeah, I think, I think yields are going to be moving higher over the medium to long term. I do think there's sort of a long-term valuation, issue with bonds. I don't think it makes sense to have the yield curve inverted indefinitely. I think that these things will correct themselves over time. I think that those are all negative carry trades, and I just think that how that will happen is in a jumpy fashion, in a sort of a step move over a long period of time. Um, so I don't think it'll be easy to trade. I don't think people should just sort of necessarily sit on perpetual bond shorts. But yeah, I think, if we look back 5 years from now, will bonds be higher in yield than they are now? Yeah, I would say yes.
Yeah. And something like debt levels and issuance, and many people, I speak to lots of investors around the world, and they often ask me this. The U.S. debt's very high, deficit's very large. The U.S. is going to have a fiscal crisis. Uh, when you look at that, does that worry you, or how do you think about sort of debt dynamics?
So I think the debt dynamics that the US and other countries are experiencing right now are pretty unique. And I think it's worth just sort of recognizing that the debt burden is overwhelmingly tied to an aging population, which is really very novel in the scope of history. And I also think it's a debt burden, unlike, if we were buying, I don't know, too many aircraft carriers, it's very easy to say, well, let's just, not buy 10 aircraft carriers, let's buy 2 aircraft carriers. Where the reality is we have an aging population. The government has committed to Social Security and other policies to help that aging population. So, and it's not going away. To me, there's sort of three ways to deal with this. One is we accept that, the government has committed to this, and we do as much as possible to help the younger generation, handle that burden. Two would be we try to cut the burden, which just doesn't really eliminate it. It just shifts it back to the households, probably in a way that burdens households even more. It makes them, I would say, risks maybe a disinflationary cycle because you basically are sort of doing the opposite of what you might have done in the first instance. You're, limiting job participation. You're sort of basically shifting the burden to the household in a way that probably contracts growth. Or third, you could, go the way of a country like Russia and just eliminate it, eliminate policy entirely, and then you see the average age of men in Russia, I think, is now down to 55. I think that's probably the least desirable way to do it. And this is not a problem that we can just sort of wish away. It needs to be dealt with. I think the US is, probably venturing more in the way of trying to grow our way out of it, which I think is probably the better way to handle it. I guess, yeah, I guess I would say I just think viewing the debt burden, this debt burden is like just a general overspending debt burden like we've seen in the past is just not a correct comparison, and I think could easily lead us down a problematic policy path.
Okay, no, understood. And then the other thing people have been looking at is whether we get some kind of risk aversion event, some kind of crisis. So last year we had the regional bank crisis, and since then people talk about commercial real estate. Of course, there's recession. People talk about as potential risk, but private equity. I don't know. I mean, do you are you worried about those sorts of things, or is it in your view it's not top of mind?
I would say I worry about it. It's not top of mind. I would say in terms of the risk that I'm more worried about now is actually a broader currency problem from the dollar being so strong. Um, I think in terms of things that will, I guess to frame it slightly differently, to me, what was happening with commercial real estate is you kind of had a situation where the interest rate that the general economy needed was higher than was tolerable for some of the banks in the commercial real estate issue. It was sort of causing a specific problem there, even though maybe the interest rate regime was correct for the rest of the economy. I think the problem that the Fed might be getting themselves into is that the current interest rate policy is maybe not very restrictive for the U.S. economy as a whole, but it's starting to cause problems for other countries around the world, and what the feedback might be there. In terms of um, sort of a exogenous risk from too high interest rates. That's where my more immediate concern is.
Okay, understood. And more generally, in terms of the rest of the world, do you have any views about what's going on in the rest of the world? One, obviously, is currency. That there could be too much currency weakness against the dollar, which could sort of spill back to the US possibly.
Mm.
Anything else?
Um, I think how China is sort of dealing with its economy and sort of speaking of real estate issues, how they're dealing with their real estate issues, I think, bears watching. I think that's being managed pretty well. Just like I think that commercial real estate issues in the US are being managed pretty well, but that's, clearly something to watch. I think is probably just as problematic as the commercial real estate issue.
Okay, great. Okay, well, I think we've covered a lot of ground. I did want to round off our conversation with a few personal questions. I always ask this of you and other guests as well. Have there been any good books or TV shows that you've consumed of late that you'd like to recommend to me?
Yeah, so I'm not sure if I would necessarily recommend it. So I've been reading and watching a lot of sci-fi recently. I first read Dune when I think I was like 14. I read it again because of the movie, and I still liked it. Um, I read Parable of the Sower, and what struck me about that, which is kind of interesting, is it's was written 30 years ago, and it's about the present day. And I'm not sure if you've read it.
No, I haven't.
I
No,
would
I
say,
haven't
yeah,
read that one. No, I've read
yeah,
Dune, but not that one.
yeah. So the um, the general idea is that climate crisis is causing a lot of economic problems and governance problems and causing people to be displaced, which is actually somewhat prescient. But to me, what struck me as most interesting about it is because it was written in the mid '90s, is there are no cell phones, no social media, and I'm not sure if you've read any um, sci-fi that really takes that into account, but it's really striking to me about how different um, phones and social media are. And I would say both of those books, there's an element of a limiting factor. So, in Dune, it's sort of what's the sort of thing that people need that's sort of at the lowest quantity. And in Dune, it's the spice. In Parable of Sower, it's water. But what struck me, just sort of listening to the story about people migrating is, I think now it's probably more electricity because it just sort of struck me if you were sort of striking out on this big path, like, it wouldn't just be where can I get water? It would also be like, where can I plug in my phone?
Yeah,
So,
absolutely. Yeah, yeah, yeah. A couple of months ago, I think we lost power in my neighborhood for like, I don't know, 10 minutes or something. It does feel like you lose connection with everything. It's quite alarming.
yeah, I'm not sure if it was a great book, but it really had me reflect on sort of how differently, life is because of cell phones and social media than people would have envisioned 30 years ago, even when, big parts of it were, about climate change and human migration were actually pretty correct.
Yeah, yeah. Okay, great. And what's the best way for people to follow you?
Um, after talking about social media, I'm not, I'm not really, very online.
Okay,
If you go to, I work at One River Asset Management. If you go to, our website, our CEO Eric writes a weekly piece. Sometimes I'm featured in there, and anything I write will usually be posted on the website there. So,
okay.
and if people are inspired by questions about this, my email's on there too. Feel free to reach out. But I try not to be too online, actually.
Okay, great. Okay, no, no, that's understandable. Okay, so with that, thanks a lot as always. You give very clear, sort of forthright views, which I always enjoy listening to. And yeah, good luck. For the week ahead. And also for the rest of the year for yourself.
Great. Thanks, Will. Nice chatting.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.